Section 5:2 Introduction to Beta, 5.2 Beta Analysis of Portfolios. Evaluating the beta of a portfolio is essential to understand its overall risk profile and the extent to which it is exposed to systematic market movements. Here's how the beta of a portfolio can be assessed and its implications on overall risk. Calculate the portfolio beta. To calculate the beta of a portfolio, you need to determine the weighted average beta of the individual holdings. Multiply the beta of each stock or asset in the portfolio by its respective weight in the portfolio. Sum up these weighted beta values to obtain the portfolio beta. For example, if a portfolio consists of 3 stocks with betas of 1, 2, 0.8, and 1.5, and their respective weights are 40%, 30%, and 30%, the portfolio beta would be 1.20.4, 0.80.3, 1.50.3, equals 1.14. Interpretation of portfolio beta. The portfolio beta represents the sensitivity of the portfolio's returns to market movements. A beta greater than 1 indicates that the portfolio is expected to be more volatile than the market, with amplified price swings. A beta less than 1 suggests that the portfolio is expected to be less volatile than the market. A beta equal to 1 indicates that the portfolio's price movements are expected to closely mirror those of the market. A negative beta implies an inverse relationship with the market, where the portfolio tends to move in the opposite direction. Implications for overall risk. The portfolio beta provides insights into the overall systematic risk of the portfolio. Higher beta portfolios are more sensitive to market movements and are considered riskier. They can experience larger gains during bullish market conditions, but also larger losses during bearish periods. Lower beta portfolios, on the other hand, exhibit lower sensitivity to market movements and may offer more stability during turbulent market conditions. However, it's important to remember that beta alone does not capture all dimensions of risk, and other factors such as non-systematic risk and diversification should also be considered. Diversification benefits. Evaluating the portfolio beta helps in understanding the diversification benefits of the portfolio. Combining assets with different beta values in a portfolio can reduce the overall portfolio beta and potentially lower the portfolio's exposure to systematic risk. By diversifying across assets with different beta values, investors can mitigate the impact of adverse market movements on their overall portfolio, aligning risk tolerance and investment objectives. The portfolio beta analysis allows investors to align their risk tolerance and investment objectives. Investors with a higher risk tolerance may prefer portfolios with higher beta values, seeking potentially higher returns in exchange for greater volatility. Conversely, investors with a lower risk tolerance may favor portfolios with lower beta values to reduce volatility and focus on capital preservation. It's important to note that beta is a historical measure and may not fully capture future market conditions. Therefore, ongoing monitoring and periodic reassessment of the portfolio's beta, considering changes in asset allocation or market dynamics, are recommended to ensure the portfolio remains aligned with the investor's risk preferences and goals. Managing portfolio beta is an important aspect of investment strategy, as it allows investors to align their portfolios with their specific investment objectives and risk preferences. Here are some strategies to manage portfolio beta based on investment objectives. Adjusting asset allocation. Asset allocation is a key driver of portfolio beta. By adjusting the allocation between different asset classes, such as stocks, bonds, and cash, investors can actively manage their portfolio's beta. For example, increasing exposure to higher beta assets, such as stocks, can raise the portfolio's beta, potentially leading to higher returns but also increased volatility. Conversely, increasing allocation to lower beta assets, such as bonds or defensive stocks, can lower the portfolio's beta, reducing volatility but potentially sacrificing some potential returns. Adjusting asset allocation is a fundamental strategy to manage portfolio beta and should be based on the investor's risk tolerance and return expectations. Diversification. Diversification is a risk management technique that involves spreading investments across different asset classes, sectors, and regions. By diversifying, investors can reduce the overall portfolio beta and mitigate the impact of adverse market movements. Including assets with low or negative correlations to each other can provide diversification benefits, reducing the portfolio's sensitivity to systematic risk. Diversification should be approached strategically, considering the risk-return characteristics of the assets and their potential impact on the portfolio's beta. Hedging strategies. Hedging strategies can be employed to manage portfolio beta by offsetting exposure to systematic risk. For example, using derivatives such as options or futures contracts, investors can take positions that counterbalance the market risk of the portfolio. By hedging, investors can reduce the portfolio's beta and limit potential losses during market downturns. However, it's important to carefully assess the costs and potential limitations of hedging strategies, as they may introduce additional complexities and expenses. Selective stock picking. Within the equity portion of the portfolio, investors can actively manage beta by selectively choosing stocks with specific beta values. By including stocks with different beta levels, investors can target a desired overall beta for the portfolio. For instance, including higher beta stocks can raise the portfolio's beta, while including lower beta stocks can lower the portfolio's beta. Selective stock picking requires thorough research and analysis to identify stocks that align with the investor's risk and return objectives. Tactical asset allocation. Tactical asset allocation involves making adjustments to the portfolio's asset allocation based on short-term market outlook and conditions. By actively adjusting the portfolio's allocation to different asset classes or sectors, investors can tactically manage the portfolio's beta. For instance, if a market downturn is expected, reducing exposure to higher beta assets may help lower the portfolio's beta and potential downside risk. Conversely, in a bullish market environment, increasing exposure to higher beta assets may capture potential upside returns. Tactical asset allocation requires diligent monitoring of market trends and making informed decisions based on the investor's risk appetite and market outlook. Regular monitoring and rebalancing. Regularly monitoring the portfolio's beta and periodically rebalancing the portfolio can help maintain the desired risk profile. As market conditions and asset prices change, the portfolio's beta can deviate from the intended target. Rebalancing involves adjusting the portfolio's asset allocation back to the desired proportions, which helps manage the portfolio's beta and risk exposure. It's important to note that managing portfolio beta requires careful consideration of the investor's risk tolerance, investment objectives, and market expectations. It is advisable to consult with a financial advisor or investment professional to tailor these strategies to your specific circumstances and to ensure they align with your goals and risk preferences.